So the three statements model. So what three-statement model, the FP&A model? The three-statement model is a fundamental tool in financial planning analysis and corporate finance. It integrates three essential financial statements, the income statement, the balance sheet, and cash flow statement, into one interconnected model. And to have a brief rundown of each component and how they interact, the income statement, this statement shows the company's revenue, expenses, profits over a specific period. It begins with the revenue, subtracts various expenses to arrive at the net income. The balance sheet, this provides a snapshot of the company's financial position at a specific point in time. It outlines assets, liabilities, and equity. The balance sheet allows a formula: assets equal to liability plus equity. Cash flow statement, this statement shows the company's cash inflows and outflows over a period. It is divided into operating, investing, and financing activities. Interaction with three-statement model. The net income, the bottom line from the income statement, flows into the balance sheet as part of the retained earnings within equity, and it's also the starting point for the cash flow statement. The balance sheet movement, changes in cash sheet items, e.g. accounts receivables, inventory, accounts payable, impact the cash flow statement. Cash flow, the ending cash balance from the cash flow statement reflects the cash position on the balance sheet. Together, these three statements provide a comprehensive overview of a company's financial performance and health, helping the FP&A professionals analyze historical debt, forecast future performance, and make informed strategic decisions. Does that answer your question, or is there another aspect you'd like to dive into? So, since I'm here, I might as well just ask that, which is what happens if these are not balanced or need a plug-in number to bring the balance sheet and cash flow to balance? Right. So what happens if these are not balanced or need a plug-in number to bring the balance sheet and cash flow to balance? If your financial statement are unbalanced, it could indicate an error or inconsistency in modeling. Using a plug number to force the balance can mask underlying issues and lead to inaccurate financial analysis. The second part of that is what I would very strongly warn against here. And here are some few reasons why the statement might not balance and how to address them: data entry errors, formula mistake, timing difference, incorrect assumptions, interstatement flow issues. Using a plug, such as plugging difference into a cash account, might temporarily fix the issue, but it obscures the real problem and undermines the integrity of your financial analysis. It's always best to identify and correct the root cause of the imbalance to maintain accuracy and reliability in your financial modeling. So with that out of the way, using something very, very simple to help to illustrate that. So here we're looking at three statements. You have the profit and loss, the statement of financial position on the balance sheet, and then the cash flow. Here I've just banged in some numbers together: subscription revenue, cost of revenue, gross profit is there for that, and the percentage is what we see. And I've used 12 months just to give us a full year's picture. Where the action begins is where you have the statement of financial position. Here what I've done is I've got receivables, that's my current assets, and then I've got my current liabilities here: capital, accumulated profit, net profit, equity, and then the balance sheet. The cash flow statement, in the hand, you can see starting off with the net profit, working capital movement, cash from operating activities, investing activities, financing activities, and then the net cash flow. So when you have something like this, and then you've got your top line, middle line, or cost, and then gross profit. And if you've got a tool that is this dynamic, just something that enables you to do that. So when you sell something in the first month for £100 and then your cost is 75, you make a profit of 25% margin, and then you end up with cash of 30 in the first month. Why is that? That's because you're going to have to sell. You've bought your goods for 75, you sold it for 100, and then you've got this 25. But your VAT, on the other hand, so they're going to pay you that, in the first month and in the second month, and then this is where you pay out your VAT. So in light of that, you can now see that your cash and cash equivalent is high in the first month, high in the second month, but then it balances out, and then you now end up with a profit actually for the next 3 months. So if you're such a kind business person and you decide to say, you know what, I'm going to give you 30-day grace, observe this, and this is what your 3 statements should be able to tell you. Observe that you now see that your cash, as a result of you giving a 30-day grace, is you now have to finance the cost of this, and as a result you now end up with being out of cash by as much as £90. And in the second month here, and it is when you now get your cash coming in, because it's 30 days, so you have 1 month lag. If you were to do this for 60, and then you see the consequences, so 2 months after, and then that keeps on happening. So these are the kind of things that you should factor in when you are creating a 3-statement model, not just the P&L section, but the kind of things that will take place around the cost, the current assets and the current liabilities with regards to that, because that's something that most often than not you would not factor in with regards to something like your subscription revenue. The net amount is what you show here, but you receive the cash including the VAT amount. Don't go spending it because it's now yours 3 months down the line, or when you pay your VAT you have to give that back. And then you have your balance sheet always netting out, because your net assets and your equity should always be the same. And then you have your cash flow that reads as follows. Your net profit is the starting position. Your working capital movement is that your cash and cash from operating activities is there for that. If these were to increase, say to 500, but because you have your cost of revenue being tied to the units, this will increase accordingly, and then you have that. But because you have this DSO, you still find yourself being significantly impacted, and that's why you want to make this as low as possible, and preferably none whatsoever. And you can see the first time as a result of when this goes out, net cash position being out is when you make your VAT payment. That's just a simple example of what a 3-statement model should look like, and hopefully you have your arms around something like this, and you don't have a plugin number or anything, as stated earlier, to bring this to balance. I do hope that you find this useful, and somewhere along the line you have something and the ability and the resource and the personnel and the tools to create something like this that help you understand exactly how the 3-statement model should be able to work, and how they must interact with each other with regards to the P&L, the balance sheet, and the cash flow statement. For now, thanks for watching. Until the very next time, happy financial planning lies in your companies. Thank you very much.